Welcome to the first video in our two-part series on an introduction to financial management. In this first part, we will look at what financial management is, the context in which it operates, and key principles underlying the discipline. In the second part, we will look at a brief overview of corporate strategy. So our learning objectives for this first video are to understand what financial management is. We will then look at the academic and practical contexts of financial management. Finally, we will wrap up the video by looking at the fundamental principles underlying financial management. So what exactly is financial management? Heffer and Walker define financial management as the effective and efficient management of financial capital in order to help an organization achieve its goals, strategy, and objectives. Els puts it very succinctly when he says it is the process of creating value in a business. What we see is that the commonly held objective of a firm in both academics and practice is value maximization. So how do we achieve this objective of creating value? Financial management identifies four key decisions. First, we have the investment decision. This decision looks at which assets our company should be investing in to create value. Second, we have the financing decision. Here we ask ourselves how the company should finance the assets it will be investing in. Next, we have the working capital decision. This decision looks at how we manage our day-to-day working capital, such as inventory, debtors, cash, and creditors. Finally, we have the dividend or distribution decision. This decision considers how much of our profits we should retain and how much should be distributed to the shareholder. So what knowledge would a good financial manager have? As you should have guessed, a financial manager should have a good understanding of how the accounting process works. This includes both external reporting requirements as well as internal reporting requirements. The financial manager should also have a strong grasp of how the economy as a whole works. The financial manager should be able to respond to both changes in the local as well as global economies. Financial managers also need a good grasp of statistics so that we can analyze and understand large quantities of data. We should also have a good understanding of the law. This understanding relates to both corporate law and tax law. The financial manager should also have a good grasp of the latest trends and regulations from a governance perspective. And related to this, needs to have an understanding of ethics and ethical behavior. Finally, the financial manager will be dealing with people and organizations. As such, they should have an understanding of both human and organizational behavior. If we look at the context in which the financial manager operates, we see there is both an internal and external environment to be considered. When considering these environments, we see the importance of that fundamental knowledge from our previous slide. Looking at the internal environment, we need to consider the company's corporate strategy, its corporate culture, its corporate governance structures, and its corporate legal structure. Legal structure would include issues such as if it is a public or private company, a partnership, or a sole proprietor. This will influence the strategy, culture, and governance mechanisms in place. For the external environment, we would need to consider the latest developments in both the local and global economies. We would need to understand the state of labor relations. We would also need to pay attention to the tax and legal systems, as well as developments in the financial markets. Now, let us wrap up this introductory video by considering the fundamental principles underlying financial management. The first fundamental principle is the time value of money. Here we need to understand that investors prefer to receive cash sooner rather than later. As a result, the value of any investment is determined by not only the size of the future cash flow, but also the timing of those cash flows. The sooner the cash flows are received, the higher the investment's value. Next, we have the principle of risk and return. We all like receiving money for no work. As soon as work is required, we demand higher compensation. Likewise, with an investor, they want as little risk as possible. As soon as risk increases, so the investor will demand a higher level of return. We then have the no arbitrage principle. Arbitrage refers to taking advantage of price differences across markets. For example, if you could buy a car in one city and then sell it for a higher price in another city without incurring any additional costs, you can make a profit by taking advantage of the price differences in cars between cities. The no arbitrage principle effectively says that we cannot expect to do this consistently, as there is no such thing as a free lunch. Our next fundamental principle is that of efficient markets. The efficient market hypothesis essentially says that markets react immediately and without bias to all new information. This means that we cannot consistently outperform the market. There are three forms of the efficient market hypothesis, namely the weak form, the semi-strong form, and the strong form. Next, we have portfolio theory. This theory deals with the diversification of investments in order to reduce the level of risk. The more assets we add to the portfolio, the lower our level of risk. However, the reduction in risk from each additional asset added reduces each time we add that new asset, until only the market-wide or systematic risk remains. Finally, our last fundamental principle is that of financial analysis. We need to be able to read, understand, and interpret a company's financial statements. Analyzing the financial statements will help us to understand the fundamental decisions taken by the company in order to create value. Remember, these fundamental decisions were the investment, financing, working capital, and dividend decisions. That brings us to the end of our introductory video on financial management. In our next video, we will look at an overview of corporate strategy. See you next time.